Friends, thank you for being here today. What if I told you that your government just admitted they destroyed your neighbor's life for absolutely nothing? That thousands of Canadian families sold their businesses, liquidated their life's work, paid massive tax bills to beat a deadline that never actually mattered, and now, 12 months later, the same government that created the panic just shrugged and said, never mind? We're not talking about a policy debate. We're not talking about a market correction. We're talking about irreversible damage. On March 21st, 2025, the federal government officially canceled the capital gains inclusion rate hike, the tax increase they announced, implemented, deferred, and finally scrapped after causing what can only be described as a fire sale of Canadian entrepreneurship. And here's the part that should make your blood run cold. The people who sold their assets in panic, they can't get them back. The family cottage that's been in your bloodline for 3 generations, sold to a private equity firm in May 2024. The manufacturing business your father built from nothing, now owned by a U.S. conglomerate. The investment property you liquidated to avoid a tax that never came, gone. This is vanishing in real time. Let me give you the scale of this catastrophe. We're not talking about millions. We're not even talking about isolated incidents. We're talking about a mass liquidation event that fundamentally restructured who owns Canadian assets. During that panic window between April and June 2024, when business owners were racing to beat the June 25th deadline, Canadian entrepreneurship didn't just take a hit, it got transferred. And the truly savage irony, the buyers weren't your neighbors. They weren't Canadian families stepping in to preserve legacy. They were the only entities with enough liquid capital to move that fast. Foreign private equity, multinational corporations, and financial conglomerates who specialize in buying distressed assets from panicked sellers. But here's where this transcends ordinary government incompetence and enters the realm of structural betrayal. This part is non-negotiable. When the government announces a tax policy change with a specific deadline and then cancels it after people have already acted, they're not just making a mistake. They're proving something far more dangerous, that the rules of the game can change mid-play, that the tax code isn't a stable framework you can plan around. It's a light switch they flicker on and off until the bulb burns out. This is where the clock actually starts. Because what we're witnessing isn't just policy whiplash, it's the death of planning itself. You cannot build a 30-year business strategy in a jurisdiction where the fundamental rules change every 3 months. And this isn't theoretical, it's observable. The data forces one conclusion. Canada has become what investors call a high policy risk jurisdiction. That's not an insult. That's a technical classification that changes how capital flows, where businesses incorporate, and whether smart money stays or leaves. Let me show you what actually happened, because the timeline reveals something the official statements never will. This is the part they never put in the official reports. Budget 2024 drops in April. Hidden in the fiscal projections is a bombshell. The capital gains inclusion rate, the percentage of your profit that gets taxed when you sell an asset, will increase from 50% to 66.67%. But here's the mechanism hiding in plain sight. They don't just announce this as a future change. They give it a retroactive style implementation date of June 25th, 2024, 10 weeks away. Now, why go through this elaborate charade? The answer is discipline, or more precisely, the illusion of discipline. The government frames this as making the wealthy pay their fair share, but the real function is revenue acceleration. By creating an artificial deadline, they trigger a stampede. Everyone who is planning to sell in the next 5 years suddenly has to sell in the next 10 weeks, or face a massive tax increase. It's not taxation. It's a forced liquidation event disguised as tax policy. And this part has already begun. Within days of the announcement, the phone lines at accounting firms across Canada light up. Business owners who were grooming their companies for eventual sale to their children are now being told by their advisors, you have 70 days to execute a multi-year exit strategy, or you're going to lose an extra 16.67% of your life's work to taxes. Cottage owners who are planning to pass properties down to their kids are getting the same message. Investment property holders, the same. The panic isn't manufactured by conspiracy theorists, it's manufactured by government policy. Here's the moment the clock actually starts. Because when you create a 10-week window for people to make irreversible financial decisions, you don't just compress timelines, you compress prices. When everyone in a market is a forced seller and the buyer pool knows it, what happens to asset values? They crater. This is not a conspiracy. It is a stated policy outcome. The government created an artificial supply shock, and the market responded exactly as economics predicts. Prices fell, transactions surged, and the people with capital sitting on the sidelines, foreign investors, private equity, financial institutions, stepped in to buy Canadian assets at fire sale discounts. This is where the first domino falls. May 2024, June 2024. The data from those 2 months tells a story the government will never officially acknowledge. Small business confidence doesn't just decline, it collapses. The Canadian Federation of Independent Business reports that 60% of owners oppose the changes. But here's the detail even analysts tend to miss. 55% said the policy directly affected their exit planning. That's not sentiment, that's behavioral change. Over half of Canada's business owners fundamentally altered their long-term strategy because the government moved a tax lever with 10 weeks' notice. But that's not the real problem. The real problem is what happens to those businesses once they're sold. A family-owned manufacturing company in Ontario that's been operating for 40 years doesn't just disappear when it's sold. It gets absorbed. The new owner, often a larger corporation or investment fund, strips out the redundancies, consolidates operations, moves headquarters. The jobs don't vanish overnight, but the local control does. The decision-making power shifts from a family in Mississauga to a boardroom in New York or a private equity office in Toronto that manages 80 other acquisitions just like it. This is the mechanism hiding in plain sight. Wealth consolidation disguised as tax fairness. Let me be precise about what this means. When they announced they were taxing the wealthy, they framed it as going after ultra-rich investors. But the threshold for the increased rate wasn't some billionaire benchmark. It was $250,000 in annual capital gains. Do you know who hits that number? A doctor who sells their practice after 30 years, an entrepreneur who finally exits the business they bootstrapped from their garage, a couple who sells the rental property they bought in 1995 to fund their retirement. These aren't the monopoly man with a monocle. These are the people who make an economy actually function. And the government just told them their life's work would be taxed at a rate 33% higher than their neighbor who sold in May. And here's where everything changes. Because what comes next isn't a market adapting, it's a market freezing. After the June 25th deadline passes, something remarkable happens. Investment stops, new business formation stalls. Why? Because if you're a rational actor and you just watch the government create chaos with a tax policy they implemented in 10 weeks, why would you start a new venture that might take 10 years to mature? What if they change the rules again in year 3, year 7? What if the exit strategy you're building today is obsolete by the time you're ready to execute it. This is where common sense actually becomes your enemy. The simple logic of work hard, build value, eventually sell and retire does not apply when the rules governing that sale can be rewritten on a quarterly basis. And this isn't speculation. We have the receipts. In the months following the June deadline, capital investment in Canada doesn't just slow, it enters what economists call a capital strike. Money that would have gone into expansion, hiring, equipment, research just stops. It goes to the United States. It goes to jurisdictions where tax policy is written in ink, not pencil. We don't have months. This is happening in days. Because now we arrive at the truly perverse part of this story, and this is where the narrative makes a turn that most people don't see coming. This is not theoretical, it's math. January 2025, the government blinks. After months of watching investment evaporate and business confidence crater, they announce a deferral, not a cancellation, not an apology, a deferral. The capital gains inclusion rate hike that was supposed to take effect in June 2024 is now pushed back indefinitely. They dress it up in bureaucratic language about reviewing stakeholder feedback and ensuring fair implementation. But here's what that actually means in plain English. They realize they broke something and they're trying to pretend it's still repairable. But once this shifts, everything above it starts to shake, because a deferral isn't a fix, it's a suspension. It's the government saying, we're not going to do this right now, but we might do it later, so stay scared. And for business owners, that's actually worse than just implementing the policy. At least with implementation, you know the rules. You can adapt, you can plan, but with a deferral hanging over your head, you're trapped in perpetual uncertainty. Do you invest in expansion? Do you hire those 3 new employees? Do you buy that equipment? Or do you wait to see if they're going to pull the tax lever again in 6 months? This is the crack that becomes an earthquake. And here is where the cascade becomes unstoppable. Because while the government is patting itself on the back for listening to Canadians, the damage they've already caused is metastasizing through the system in ways they either don't understand or don't want to acknowledge. Let's walk through the forensic evidence, because this is where you see how deep the rot actually goes. Here's the part nobody expects. The Canada Revenue Agency is currently drowning in what they're calling corrective reassessments. What does that mean? It means that thousands of corporations and individuals who filed their 2024 taxes under the assumption that the new inclusion rate was law because the government told them it was law, now have to go back and refile everything. But the CRA doesn't have the infrastructure to process this volume of corrections. Their systems weren't built for policy whiplash. Let me show you what this looks like on the ground. You're a small business owner. You sold your company in May 2024, paid your capital gains tax at the old rate to beat the deadline, filed your corporate return in February 2025, and then in March, the government announces, actually, that deadline was fake. Now what? Do you file an amended return? Do you wait for the CRA to automatically reassess you? Do you claim a refund for the difference between what you would have paid under the deferred rules versus what you actually paid? Nobody knows, because the CRA hasn't issued clear guidance. And when you call them, you get put on hold for 3 hours and then disconnected. This part is non-negotiable. Administrative chaos is a tax in itself. The hours you spend trying to figure out what the government wants from you, the accounting fees you pay to navigate the confusion, the opportunity cost of not being able to focus on actually running your business, that's all a hidden levy that never shows up in the official budget projections. And this is where the countdown quietly began. This is the detail even analysts tend to miss, and it's absolutely diabolical. While everyone was focused on the capital gains drama, the government also quietly raised the alternative minimum tax, AMT, in the same budget package. The AMT is essentially a parallel tax system designed to catch high earners who use too many deductions, and they increase the rate from 15% to 20.5%, while also expanding what income counts toward the calculation. Here's why this matters and why it's so insidious. Even though they deferred and then canceled the capital gains hike, many of the people who panic sold in spring 2024 still got hit with the higher AMT. Because when you realize a large capital gain in a single year, even at the old 50% inclusion rate, you can trigger AMT. So the government created a situation where business owners sold their life's work to avoid a tax increase that never happened, only to get caught by a different tax increase that did happen and that nobody was paying attention to. Let me be precise about the mechanism. Say you're a doctor who sold your medical practice for $2 million in May 2024. At the old inclusion rate, you'd have a taxable gain of $1 million. But because you also have other income that year, and because the new AMT rules capture a broader base, you suddenly owe an extra $50,000 to $75,000 in AMT that you weren't expecting. You sold your practice to avoid a tax increase. You paid the capital gains tax. And then the government hit you with a second tax through the back door. This is not a conspiracy. It is a stated policy outcome. Here's where the part that scares me comes in, because the AMT trap reveals the actual strategy at work here, and it's far more sophisticated than simple incompetence. The government needed revenue. They knew a straight capital gains hike would be unpopular, so they announced the hike, triggered the panic selling to accelerate revenue collection through transaction volume, and simultaneously raise the AMT to catch the people who rushed to sell. Then once they'd collected the revenue, they could listen to Canadians and cancel the hike, looking magnanimous while pocketing the tax revenue from both the fire sale and the AMT increase. And here is where everything changes. Now let's talk about who actually bought all those businesses and properties that Canadians panic sold in spring 2024. Because this is where the transfer of wealth becomes the transfer of control. And this is where Canada's economic sovereignty takes a permanent hit. When you create a forced liquidation event with a 10-week window, you're selecting for a very specific type of buyer. You're selecting for entities that have large amounts of liquid capital that they can deploy fast. Who are those entities? They're not your neighbor who needs to get a bank loan approved. They're not the employee who's been working at the company for 20 years and always dreamed of buying it someday. They're institutional investors, private equity funds, foreign corporations, real estate investment trusts, the predators who specialize in buying distressed assets from panicked sellers. Here's what that looks like on the ground. A manufacturing company in Hamilton that's been family owned for 3 generations gets sold to a U.S. private equity firm for 30% less than it would have fetched in a normal market, because there were 50 other similar companies for sale at the same time, and the buyer pool knew it. A cottage property on Lake Muskoka that's been in your family since 1970 gets sold to a numbered corporation owned by investors you'll never meet, who'll flip it to a different investor in 3 years. An apartment building in Vancouver that provided stable, below-market rent to long-term tenants gets acquired by a REIT that immediately raises rents to market rate and starts pushing out legacy tenants. This is the moment small businesses get crushed. But here's the counterintuitive pivot that nobody talks about. This isn't accidental collateral damage. This is the intended function of the system, even if the politicians implementing it don't consciously understand it. When you force a fire sale through policy panic and the buyers are institutional investors with deep pockets, you're effectively engineering a wealth transfer from the middle class to the financial class. You're consolidating ownership. You're reducing the number of independent operators in the economy and increasing the share controlled by large, bureaucratized entities. Let me show you the numbers, because this is where theory becomes observable fact. According to the Canadian Federation of Independent Business, 55% of business owners said the capital gains announcement directly affected their exit plans. But here's the data point that makes this real. In a normal year, approximately 10% of small businesses change ownership. In 2024, during the panic window, that number spiked to estimates of 15 to 18% in certain sectors. That's not a marginal increase. That's a forced acceleration of ownership transfer, compressing 5 to 10 years of natural business life cycle into a few months. And once a business is sold, it's gone. You can't unscramble that egg. This is where the domino setup completes, because every business that got sold to private equity, every cottage that got bought by a foreign investor, every apartment building that got absorbed into a REIT, those assets aren't coming back. When the government canceled the policy in March 2025, they didn't offer a buyback program. They didn't create a mechanism for sellers to reverse their transactions. They just said, oops, and moved on. The people who sold lost their assets permanently. The people who bought got bargains they'll profit from for decades. For the average household, this means your neighbor who sold their business is now working for the company they used to own, watching the new owners extract value they'll never see. It means the cottage where your family spent every summer is now a short-term rental listed on Airbnb at $800 a night. It means the apartment building where you've lived for 15 years just got bought by a corporation that sees you as a line item on a spreadsheet, not a human being. But this isn't even the part that scares me most. Let's talk about Budget 2025, because this is where the government's desperation becomes transparent. After spending a year destroying business confidence, triggering a fire sale of Canadian assets, and creating administrative chaos at the CRA, they realized they had a problem. Investment was collapsing. Capital was fleeing. The people who create jobs and drive productivity were either selling and leaving or just freezing all expansion plans and waiting to see what insanity the government would inflict next. So what did they do? They introduced what they're calling the productivity super deduction. It's a tax incentive designed to encourage businesses to invest in equipment, technology, and automation. On paper, it sounds reasonable. In reality, it's a bribe. It's the government saying, we know we destroyed your trust, so here's a tax break to try and make you forget about it. Here's the part the experts gloss over. A tax deduction is only valuable if you're planning to make a profit. But if you're a business owner who just watched the government create policy chaos that destroyed billions in asset value, are you really going to invest millions in new equipment based on their promise of a tax deduction? What if they change that policy next year? What if the deduction gets cancelled in Budget 2026? What if they raise corporate taxes to offset the lost revenue from the deduction? This is where common sense actually becomes your enemy. The government thinks they can repair trust with incentives, but trust isn't rebuilt with carrots and sticks. Trust is rebuilt with predictability, with stability, with the commitment to not treat the tax code like a game of legislative whack-a-mole where the rules change based on polling numbers and fiscal pressure. We don't have months. This is happening in days. And this leads us to the system's most crucial secret, which is really the psychological foundation that makes all of this possible. Because what we're dealing with here isn't just bad policy, it's sovereign risk wearing a friendly face. Sovereign risk, that's the term investors use when they're evaluating whether a government can be trusted to honor its commitments. Traditionally, it's applied to developing nations with unstable political systems countries that might nationalize foreign assets or default on their debts. But here's the counterintuitive pivot that should terrify you. Canada just earned that designation through its own actions. Let me cut through the noise and show you why this matters. When you create a tax policy, announce it with fanfare, give it a legal implementation date, force thousands of people to make irreversible financial decisions based on that date, and then cancel the policy after the damage is done, you're not just making a mistake. You're demonstrating that your word has no value. You're proving that the legal framework governing property rights and taxation is subject to change based on political convenience. And once that demonstration is made, it cannot be unmade. This part isn't a prediction, it's math, because capital is mobile and capital is cowardly. It doesn't care about your feelings or your national pride. It goes where it's treated best, where the rules are stable, where you can make a 20-year plan without worrying that the government will rewrite the terms in year 3. And right now, capital is learning a very simple lesson about Canada. The rules are written in pencil, not ink. Here's what that looks like in practice. You're a successful entrepreneur in your 50s. You've built a technology company worth $10 million. You're planning your exit strategy. Maybe sell to a larger competitor. Maybe transition ownership to your executive team. Maybe take the company public. But now you have to factor in a new variable: policy risk. What if the government announces another tax change with a short deadline? What if they raise corporate taxes? What if they implement wealth taxes? What if they change the rules on stock options or dividend taxation? And here is where the cascade becomes unstoppable. Because once you start factoring policy risk into your calculations, the rational response isn't to double down on Canada. It's to diversify away from Canada. You incorporate your next venture in Delaware instead of Ontario. You structure your holdings through jurisdictions with constitutional protections for property rights. You move your primary residence to a province or country with more stable tax policy. You don't do this because you're unpatriotic. You do it because you're rational, and rationality demands that you protect yourself from a government that has proven it will sacrifice your interests for short-term political gain. This is where the first domino falls, and it falls silently. Because the brain drain isn't just about people physically leaving, though that's happening too. It's about capital allocation. Every dollar that would have been invested in expanding a Canadian factory that instead goes to building capacity in Texas. Every talented graduate who takes a job in Seattle instead of Toronto because the compensation structure is better and the tax environment is more predictable. Every family office that shifts assets into U.S. real estate or European bonds instead of Canadian equities. The data forces one conclusion: Canada is bleeding economic vitality, and the capital gains fiasco is both a symptom and an accelerant of that decline. But here's where everything changes, and this is where we need to zoom out from the specific policy failure and look at the broader pattern, because what happened with capital gains isn't an isolated incident. It's a template. It's a preview of how governments behave when they're under fiscal pressure and running out of options. Let me be precise about what's actually happening here. The government has a structural deficit. They've been spending more than they collect for years, funding the gap with debt. But debt has costs, interest payments that grow every year. And as those interest payments consume a larger share of the budget, they have less money for everything else. So they face a choice: cut spending, raise broad-based taxes, or find creative ways to extract revenue without it looking like a traditional tax increase. The capital gains ambush was option 3. It was presented as fairness, making wealthy Canadians pay their share. But the real function was revenue acceleration through forced liquidation. They knew that by creating a deadline, they'd trigger a wave of asset sales, which generates immediate tax revenue from the transactions themselves. It's a one-time revenue boost that gives them breathing room in the current fiscal year, even if it destroys long-term economic productivity. And this is the mechanism hiding in plain sight: short-term fiscal relief purchased with long-term economic damage. Here's the part they never put in the official reports. When you force business owners to sell their companies prematurely, you're not just transferring ownership, you're destroying embedded knowledge. The owner who sold their manufacturing company in May 2024 wasn't just selling equipment and inventory. They were selling 3 decades of relationships with suppliers, intimate knowledge of their workforce, understanding of market dynamics, problem-solving expertise accumulated through thousands of small crises. That knowledge doesn't transfer to the private equity firm that bought the company, it evaporates. For pensions, this is catastrophic because pension funds are major investors in Canadian businesses and real estate. When asset prices get compressed through a forced liquidation event, pension fund holdings lose value. When businesses get consolidated and their operations get streamlined by new owners looking to maximize profit extraction, employment decreases, which means fewer workers contributing to pension plans. When economic growth slows because of capital flight and reduced investment, the returns that pension funds need to meet their obligations become harder to achieve. This is where the countdown quietly began, and most Canadians don't even know the clock is running. Now let's talk about what comes next, because the capital gains reversal isn't the end of this story. It's the beginning. The government is now in a worse fiscal position than they were before because they've spent the one-time revenue boost from the fire sale. They've lost the ongoing revenue they were expecting from the inclusion rate hike, and they've damaged their own credibility so severely that investors and entrepreneurs are now in capital strike mode. So what happens when a government is desperate for revenue, has exhausted traditional options, and has already proven they'll sacrifice long-term stability for short-term gain? Let me show you what actually comes next. The wealth tax. They'll call it something else: a luxury tax or excess profit tax or pandemic recovery contribution, but the function will be the same. They'll target assets, not income. They'll go after real estate equity, investment portfolios, business valuations, and they'll do it with the same playbook. Announce it suddenly, implement it quickly, create panic, collect revenue, and then maybe walk it back after the damage is done. The estate tax. Canada currently doesn't have an inheritance tax. You pay capital gains on the deemed disposition of assets at death, but there's no separate estate levy. That's an obvious revenue target for a desperate government. Frame it as fairness. Set a high threshold so it only hits the wealthy, and collect billions from families who spent their lives building something to pass on. The exit tax. They'll make it harder to leave. If you're a high net worth individual or a business owner who wants to relocate to a different jurisdiction, they'll implement departure taxes that force you to pay capital gains on your assets as if you sold them, even if you didn't. It's a border wall made of tax policy. This is not theoretical. It's observable in other jurisdictions that went down this same path. France implemented wealth taxes and watched capital flee. California raised income taxes on top earners and saw population outflows to Texas and Florida. The pattern is consistent. When governments treat their most productive citizens as ATMs, those citizens leave, and then everyone else pays the price through reduced economic dynamism and higher taxes to fill the gap. And here is where everything changes, because we need to talk about what you do with this information. Let's address the psychological component first, because this is actually the hardest part. Human beings are hardwired to believe tomorrow will look like yesterday. It's called normalcy bias, and it's the reason people don't evacuate before hurricanes even when they're told to leave. It's the reason investors stay in collapsing markets because it's always come back before. It's the reason Canadians will read about this capital gains disaster, shake their heads at government incompetence, and then do absolutely nothing to protect themselves. Here's what that looks like on the ground. You're going to read this, you're going to think, wow, that's terrible. And then you're going to go back to your normal life. You won't restructure your assets. You won't talk to a tax strategist. You won't consider diversifying your holdings across jurisdictions. You'll assume that somehow this won't affect you, or that the government will figure it out, or that things will just work themselves out. But once this shifts, everything above it starts to shake, because the window for preparation is measured in policy cycles, not decades. If you wait until they announce the next tax ambush, you're already too late. The whole point of a deadline is to prevent you from planning around it. By the time you hear about the policy change, you have weeks to make decisions that should take months or years of careful consideration. So here's the binary choice, and this is where we move from analysis to action. Option 1, trust the system. Believe that the government has learned from this disaster. Believe that they won't try another revenue grab disguised as fairness. Believe that your assets are safe, that the tax code will stabilize, that Canada's economic trajectory will improve. Continue investing as you always have, building your business, accumulating assets, and hoping that when you're ready to retire or exit, the rules will still be favorable. Option 2, act as if sovereign risk is real. Structure your affairs defensively. Diversify your holdings across jurisdictions. Consider incorporating new ventures outside Canada. Look at real assets that governments can't easily devalue: land, commodities, precious metals. Create optionality so that if policy whiplash happens again, you're not trapped making irreversible decisions under artificial deadlines. Let me be clear about what I'm advocating here. I'm not telling you to abandon Canada or evade your obligations. I'm telling you to treat the Canadian tax system as a hostile variable that requires defensive positioning, the same way you'd approach any other investment risk. And here's where the domino sequence completes, because the tragic irony of all this is that the government's actions are creating the exact outcome they claim to be trying to prevent. They say they want to keep capital in Canada, support small business, encourage entrepreneurship, but by implementing chaotic policy changes with short timelines, they're driving capital away, destroying small businesses through forced sales, and teaching entrepreneurs that Canada is a jurisdiction where long-term planning is impossible. This was inevitable the moment they announced the June deadline, because once you demonstrate that the rules are changeable on political whim, you can't undo that demonstration. Trust takes decades to build and moments to destroy. The capital gains reversal might have provided short-term political relief. They can claim they listened to Canadians, but the long-term damage to Canada's reputation as a stable jurisdiction for investment is permanent. Friends, here's what I need you to understand. This story isn't about taxes. It's not really about capital gains rates or inclusion percentages or AMT calculations. Those are just the technical details. This story is about predictability versus chaos. It's about whether you can make long-term decisions in an environment where the government treats the tax code like a game board they can rearrange whenever they need quick revenue. And the answer Canada just gave to the world is no, you cannot. History favors the prepared, and the window for preparation is closing, not because some cataclysmic event is about to happen tomorrow, but because the erosion is cumulative. Every policy reversal, every tax ambush, every demonstration that the rules are negotiable, they stack on top of each other until you wake up one day and realize you're living in a jurisdiction that sophisticated capital has already written off. The people who sold their businesses in May 2024 learned this lesson the hard way. They can't get those assets back. They can't reverse the decision they made under pressure. They paid real money, suffered real consequences, and reorganized their lives around a deadline that turned out to be meaningless. Don't let that be you in the next cycle, because there will be a next cycle. The fiscal pressures that drove this disaster haven't gone away. The government's need for revenue hasn't diminished. The pattern has been established. And once a government learns they can extract money through policy panic and then reverse course without facing real accountability, they've learned a technique they'll use again. This is where the clock actually stops for this particular story, but it's where the larger clock starts ticking for anyone paying attention. The question isn't whether they'll try something like this again. The question is what form it will take and whether you'll be positioned to weather it when they do. The liquidity tide is going out, friends, and we are about to find out who is swimming naked. Thank you for being here today.